Ladies and gentlemen, good day and welcome to Q4 FY24 conference call of Shemaroo Entertainment Limited, hosted by Valorum Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on a touchtone phone. I now hand the conference over to Ms. Purvangi Jain from Valorum Advisor. Thank you, and over to you, ma'am.
Good afternoon, everyone, and a warm welcome to you all. My name is Purvangi Jain from Valorum Advisors. We represent the investor relations of Shemaroo Entertainment Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the fourth quarter and financial year ending 2024. Before we begin, a quick cautionary statement. Some of the statements made in today's con call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to the management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. I would like to introduce you to the management participating with us in today's earnings call and hand it over to them for their opening remarks. We have with us Mr. Hiren Gada, CEO, Mr. Amit Harya, CFO, and Mr. Argo Chakravarti, COO. Without any further delay, I request Mr. Amit Harya to start with his opening remarks on the financial highlights. Thank you, and over to you, sir.
Thank you, Purvangi, and good afternoon, everyone. And welcome to our earnings call for the fourth quarter and the financial year ended 2024. Let me first start by giving you some key financial highlights, after which our CEO, Mr. Hiren Gada, will give you some of the operational highlights. For Q4 FY24, the revenue from operations stood at around INR 199 crores, which witnessed a growth of around 21% on year-on-year basis. EBITDA loss for the quarter was around INR 8 crores, and net loss was reported at approximately 14 crores. For the financial year ended 2024, revenue from operations stood at 707 crores, representing a growth of 27%. Year-on-year, EBITDA loss stood at approximately 26 lakhs, and net loss was around 41 crores. With regards to the new initiatives in Q4 FY24, the expenses amounted to about 10 crores, while for the year ended FY24, it was about 81 crores. And if you were to adjust for this investment, the adjusted EBITDA for the existing operations in Q4 and year ended FY24 would have been approximately INR 3 crores and 81 crores respectively. Digital media revenues for the fourth quarter stood at around INR 64 crores, up by 20% year-on-year, while for the financial year ended it was around 249 crores, witnessing a growth of around 11% YOY. Traditional media revenues for the fourth quarter stood at 135 crores, which grew by around 21% YOY for the financial year ended, and it was around for the financial year ended it was around 458 crores, witnessing a growth of roughly 38% year-on-year. Now I would request our CEO, Mr. Hiren Gada, to give the operational highlights for the period under review.
Thank you, Amit, and good afternoon, everyone. Q4 FY24 was marked by a strong performance, with robust revenue growth of around 21% year-on-year, driven primarily by our B2B businesses. As part of our ongoing commitment to strengthen our financial health, we have initiated a series of measures this quarter, focusing on accelerating inventory charge-offs and prioritizing debt repayment. Upon due consideration with various stakeholders, the management has taken a bold decision to change the amortization estimation of the company's content inventory. We expect the existing inventory to be reduced by around 40 to 45% in the next 2 years. This is not considering fresh investments in content. Furthermore, We are also aiming to bring down the overall debt by about 100 crore over the next 2 years. While these actions have led to subdued margins in the current quarter and are expected to keep the margins under pressure in the near term, it is important to note that these charge-offs are purely accounting measures. They have no impact on the monetization potential of our content library, nor do they affect our revenue or the ability to generate free cash flow. We are confident that these strategic steps will fortify our balance sheet and unlock the intrinsic value of the company. In our digital segment, Shemaroo continues to gain traction, particularly with our Gujarati content offering. This quarter, we released 13 new titles, including movies, web series, plays, expanding our content portfolio. Noteworthy titles include blockbuster movies Hello, Beti Kare Boj Hoti Nathi, along with original web series such as Varso and Vatma Adla Badli. On YouTube, Shemaroo Filmi Gaane has achieved a remarkable milestone, becoming the 22nd most subscribed channel globally, and with 68 million subscribers, reflecting our growing digital footprint and audience engagement. In our broadcast segment, we launched the original show Chahenge Tumhe Itna on Shemaroo Umang, further enhancing our content offering. Our general entertainment channels continue to perform well, with GEC channels securing a viewership share of approximately 7.1% in the overall Hindi GEC channel. With that, I would like to now open the floor for questions, the Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, Hiren and team. You're able to hear me?
Yes, I can hear you. Can you hear me?
Yes, I can. So Hiren, my first question is about this inventory charge-off. And you guys have changed the amortization policy, but as you say, it's more of an accounting entry. So given that, how will it help us in terms of, lightening the balance sheet? And the reason I'm asking this is that, I think I've been following our company for many years, and for various internal and external reasons, the debt reduction has not taken place, including this year where we were aiming for at least 30% kind of a debt reduction. So why would it happen now? What has changed or what will change? If you can talk a bit about that, because more than P&L, the concern is surely on the balance sheet side.
Sure. Thanks, Dhwanil, for this question. I would, before I get down to answering, I would first like to clarify that this year we are targeted not a 30% debt reduction, but a 30 crore rupees debt reduction.
Sorry, 30 crore. Yeah, sorry.
So, as you know, and which we discussed in the last quarter, that so first I'll just quickly finish off why that has not happened, and then we'll move on to what is the thought process for this. Basically, we had targeted a 30 crore debt reduction from around 320 crores to 290 crores. That is what we had aimed for this current financial year. As you all are aware that Q3 was a extraordinarily bad quarter for the entire industry, including us, and we had reported a heavy loss. And that loss, in fact, has held us back from this number. I would also like to draw the attention that the debt in December Q3, 9 months, December 23 end was 362 crores, which by March we have already brought it down to 338 crores. So there is a strong underlying cash flow generation which is happening. So now coming back to the question on why, or firstly I want to give a little context on what we have embarked and why we have embarked on this, is that last 2 to 3 years, and even probably prior to that also, but particularly more in the last 2 to 3 years, we've always had this question in terms of the overhang, that debt and inventory. Both these questions kept, and there was a third linked question, which was free cash flow generation, which we kept having for last 2 to 3 years particularly. So we kind of looked at this whole and that has been one of the impediments to the value discovery. I mean, so today we are at a 700 crore top line, which for our industry puts us into a certain league, or not a small player kind of a league, but that is not reflective in our market cap or the kind of valuation that we believe should be happening. And when we reflected back, or even did some research on why this is the case, our clear understanding came out to be that this combination of balance sheet correction which needs to happen is something that is likely to do that. Now, balance sheet correction is not one thing. It's not just debt repayment. It's a combination of inventory paring down. It's a combination of inventory and debt, because they are both opposite sides of the balance sheet. So I think that is really what we have attempted to address this. In a way, I would say take the bull by the horn, and over a period of disciplined execution, bring it down to a level which kind of makes the whole balance sheet and the underlying business financial in a comfortable position. That has been the thought process, and in doing so, we are obviously demonstrating free cash flow. Now, the whole idea here, we believe that over a 2-year period, if the existing inventory can come down by 40 to 45%, if the debt can come down by about 100 crores, that makes the whole financial outcome extremely strong, and that can help help the value discovery process.
Right, but here my question still remains that this more of an accounting inventory charge of an accounting entry. So what is the plan to reduce this 100 crore debt? Because those kind of things have not happened in the past. So that is what I want to understand. Are you going to reduce the investment in the new initiatives going forward, hence expecting better cash flow and then debt reduction? What is the kind of gliding path for the debt reduction?
Sure. Okay, sure. So I'm just coming back. I was trying to answer the question on the inventory part, but yeah, debt part also I'll come to. So we have good visibility on the content monetization already. In fact, in this quarter itself, we have been able to generate a certain amount of cash flow, which has helped bring the number, the debt itself from 362 to 338. If I have to put it, it's brick by brick. There are multiple, different triggers and aspects. Firstly, on our investment businesses, the expected investment, now that the businesses have reached a certain stage, is definitely not, it's going to be significantly lower than what we have invested last year. In fact, it would have, last year also the budget was lower, but there were some extraordinary events. This year we have actually built the investment plan and the annual operating plan in a way that the investment in a way stays fairly stable or at a much lower number than what we had last year. So firstly, there is a lower investment, which is combination of, which is a lot to do with the progress of this business itself and a few other market forces combination that we have expected. Second is that the cash flow generation on the content library has been growing for last few years that we have expected. So there is a certain growth in the cash flow generation itself that we have done. So it's a combination of maturing of the investment and growing of the cash flow that is expected. So based on that itself, last year also we had estimated, but as I said, this year we have a fair visibility on the numbers.
Okay. So to follow up on this, so essentially what we are saying is that 100 crore debt reduction in couple of years, which means 40-50 crore reduction every year. Is that a right assumption to make?
Correct.
Okay. And second question, you are saying that we will reduce the inventory by 40 to 45% in again 2 years. So we are almost charging of 280-300 crore in over 2 years. So roughly the accounting charge off will be around 35 to 40 crore a quarter. Again, is that a right number to look at?
Yeah. Amit?
Okay.
Yeah.
Okay. I have more questions. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Shivam Agarwal from Equity Capital. Please go ahead.
Hello, sir. Am I audible?
Yeah.
Thank you, sir, for giving me the opportunity. Sir, I have a couple of questions. First, it's with the recent completion of our tenure of our 2 independent directors. So could you provide insights into our strategy for reconstituting the board and till when the time appointments will going to complete?
Amit, you want to talk about it?
So we have already announced for the appointment of the new directors.
Okay, sir. So the independent directors are appointed?
Yeah, we already appointed.
2 new independent directors have already been.
This is the outcome of the meeting. It clearly states out the appointment details.
Yeah, this was filed on Friday itself, the details of the 2 independent directors.
Okay, sir. I missed that, sorry. And so second thing, considering the annual salary in our Shemaroo, it's 115 crore approx. So this is our recent focus on hiring top tier management. So can you provide the update?
Your voice was cracking a little bit. Can you please repeat the question?
So considering the annual salary expense of 115 crore and the recent focus on hiring top tier management. So can you please provide me on whether we are currently hiring initiative or complete or any other, what are the projected salary for expense like in current FY25?
So our overall hiring broadly is in place and now any further hiring would be broadly incremental in nature, not the kind of upgrade we have done over last 2 financial years. The additional cost or the number of for this year, while I'm not in a position to give it to you, I can just say there are 2 components which will lead to a addition in FY25. One is of course the normal salary increments that we would have given to the team from 1st April, effective 1st April onwards. And second is that we had some of the talent join us mid-year between say June, July to almost October, November. Their annualized, so there we may have had an annualized, prorated payout which will kind of get annualized from henceforth onwards.
So we are not looking for a massive increase in number. It's only.
It would be incremental, as I said, combination of normal increments and some annualization of some of the existing numbers.
So you can please.
This also yes, sorry. I think just to answer, I think large part of the entire part of the top level hiring is not complete. So anything now happens will be all incremental basis normal.
Okay, sir. Yeah, that's it. That's from my side.
Thank you. The next question is from the line of Manvardhan Bed from Laurel Advisory Services. Please go ahead.
Hello. So I just wanted to understand that because we've now embarked on this drive of writing off inventory, and I think even this year we've written off almost close to 50 crores of inventory. So I just wanted to understand the process behind writing off this inventory, and what slightly maybe if you could sort of explain as to why are we writing off more inventory than what our P&L kind of permits. So that actually weakens our net worth, erodes our net worth the moment we start showing losses. So just curious around that point.
So again, coming back to what I said earlier, so I'll answer it in two parts. First, I'll try and answer the second part. So as we discussed that this is this has been a question or challenge or kind of feedback constantly from various stakeholders that we have received at in relation to the overall size and financials, the inventory is high and the debt is also high. And this step has been taken to kind of correct that. There is a, one-time kind of an accelerated charge off that was, that has been embarked on and that has been envisaged. Now, yes, in the short term, while it will definitely lead to P&L losses, we expect that, once that is done with, the underlying profitability and, more lighter balance sheet will kind of throw up far better opportunities, far better, ratios and far better visibility of the intrinsic worth or the intrinsic value of the company. That's the thought process and the confidence with which we have kind of embarked on this. Now, to answer your other question on what is the process. So, typically, we have been charging it off. So, so for rights which we had for longer period, which is 10 years and above, we have been charging it off in 2 5-year cycles broadly, so that we are able to cover the monetization time frame in a 10-year period. What we have now done for a certain portion of the inventory is to accelerate that and reduce that 10-year into a lower number. So that's the broad change that
Okay. And just also wanted to understand the impact on taxation of this measure, that when we aggressively write off, are we permitted to carry forward these losses?
Yes, we are allowed to carry forward the losses as business losses.
Okay. Right. If you could also update us on the GST matter. I think there was a provision that has been made this year, and where do we stand on that matter with the authority?
Sure. So, as far as the GST is concerned, as on date, we don't have any further update or communication from the authorities. There is no demand. There is no show cause or any such thing. We have been providing details that they have been, asking us for. And as and when we receive any show cause or something, we will definitely anyway need to update, and we will update. So there is no change on that in any case. And I would just like to, so fundamentally the matter is sub judice and continues to stay so. But I would just like to do two things. One is, of course, reiterate that we believe that all the statutory dues and compliances have been duly paid and filed by the company. Okay. And secondly, as a matter of prudent accounting practice, the amount that we have paid, which is the 12 crores under protest, which has been paid to the department, that we have charged off as a provision, or we created a provision under other expenses in this year.
So we believe the amount is fully recoverable, and hence there is a provision made, not a write-off, basically.
Understood. Also, a broad comment on the advertising environment. I mean, this quarter top line was strong. So,
sure. Argo, you want to take that?
Let me answer that. Argo, yeah. Am I audible?
Yes.
Okay. So I think our top line growth, as you see, we have indicated in the call itself, has come on the back of some strong B2B revenues. We've had some, as we have indicated in the past, these B2B syndication revenues are lumpy in nature, and some of those revenues accrue to us in this quarter. So I think that is in course in this quarter. Advertising revenues, while at an overall level we can see that the FMCG advertising revenues are showing some signs of revival. Not yet fully up there, but definitely better than the last quarter. It is moving positively. The indications are positive. Hopefully, after the election and there is certainty in the market, things would be better. But there are signs of some revival in the FMCG business. Not so much in the e-com and the other parts of the business. And it is visible in Hindi GEC, but more so in the regional space and in news and sports. But it is very faint, but it is positive definitely compared to the last couple of quarters.
Fair enough. Right. Thank you. I'll just get back in the queue.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Thank you. The next question is from the line of Shakshi Chabra from Swan Investments. Please go ahead.
Yeah, hello sir. I just wanted to understand that on your accelerated inventory write-off, so even on the fresh content that we would be acquiring, this would be applicable, and if so, in the first year, what is the percentage of write-off that you will be doing on fresh content?
Sir, you mean to say is the policy applicable for the fresh content?
New content. Yes, that's my question.
Yeah, so wherever as I said, certain type of content, if the fresh content falls into that bracket of that, it would be applicable.
So can you explain that a little more in detail?
Like what here also, that depending on certain type of content and certain aging of content, we had earmarked a 10-year kind of charge-off policy, which we have shortened to different timelines based on the aging and other criteria. So any content freshly acquired which falls into that same category will be applicable.
Okay, but how is that categorization defined? Like, I'm not able to understand that.
As I said, so there are some parameters have been applied which are based on the aging of the content and the monetization.
So the estimated life of the content.
Yeah. So that estimated life of that content, which earlier was estimated at 10 years, has been brought forward, as in it has been reduced.
It would be reduced to about, on an average,
So as I said, different this thing has been reduced literally from 2 years to between 2 and 10 years. But some of it has been brought meaning a lot of it has been brought forward, basically.
Okay, got it. Thank you.
Yeah.
Thank you. The next question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. Good afternoon, Virender.
Yeah.
Virender, so in this quarter, how much inventory write-off have we done? Have I missed that?
As a result of the policy?
Yes. The incremental inventory write-off for the amortization?
Approximately around 10 odd crore incremental write-off would be there.
And that will be included in the operational cost? Or
Yes. It's always there.
Because I was unable to locate that properly because neither could I look at it for the cash flow.
All content consumption will always come under operational cost. It's a direct operational cost.
Agree. So you will have one effect on the operational cost, and since you mentioned it is a non-cash item, so are we also putting it accounted under the cash flow?
So, the accounting charge-off doesn't have a cash flow impact. What it has is the second effect of that goes into stock.
In the cash flow, there is...
Okay. So in the cash flow, it will be accounted under the inventory wala part.
Yes,
correct.
Is that barabar, no?
Yes.
Okay. So, okay, got it. And secondly, on the business side, see our traditional media in last 3-4 quarters again, digital media in last 3-4 quarters has remained kind of flattish. Or I would put it even for last 6-7 quarters right from September 22, we have been coming in the range of 60 crores odd, 60 to 65 crores ka range. So how do you look at this new media sales to grow? What are we trying to do over there? Just to understand this.
Sure. So, Argo, you want to take it or?
No, go ahead. I'll add on.
Okay. So, sorry, guys, actually, Argo is outstation, so we are not in the same room, so sorry about that. So, see, let's understand the context for digital media. So, in digital media consumption, post the COVID surge that has happened, there has been some clawing back or reduction back, and that probably is still playing out, or maybe towards the end of that playing out cycle. So probably COVID took something which was at 100 maybe to 200 or thereabouts. Post-COVID, things have normalized back to 150, 130, 160, somewhere there. So there is and obviously COVID created a high base impact for everyone, which kind of caused a slowdown or a optical at least slowdown kind of a thing. And that is across the digital ecosystem, particularly in video consumption, we have definitely seen that. And whether it's, all platforms, and this is documented if you see the latest, industry reports from most of the experts also, they talk of a similar kind of a thing. So the overall underlying landscape itself is kind of seeing a tempering of that growth, which is a post-COVID adjustment. We expect that probably that adjustment period may be nearing its end or may take 1 or 2 more quarters to finish that adjustment, post which the normal growth, will catch up and start, coming back. However, now that the base itself has grown so large, and this I'm talking, Rahul bhai, at an industry level, of course. So at an industry level, since the base has itself grown so large now there's, to 20+% growth rates and all of that are not really going to be, they are going to be very difficult to replicate and achieve in the visible future. So therefore, we expect that, or in fact, the industry reports also suggest that growth rate coming down to somewhere in the 13 to 15% kind of number. In fact, last year also, calendar 23, it has been in around some 15% kind of a thing. We have in fact done better than that, and our effort will be, since we also, I'll add one more factor, is that we command a very high viewership share on all the categories that we operate in YouTube, particularly on the Bollywood side, film, music, etc. So for us also to move the needle, our dependency on the underlying growth is very very high. Within that, we have been growing faster. So maintaining or gaining our viewership share kind of a thing. So that is broadly, and we have a strong content pipeline lineup and content plan as usual, which has kind of given us already a good growth number, and we are confident that that should be fairly doable.
I think let me just add on to what Hiren said. So there are two aspects to it. Obviously, one which is viewership led, which Hiren just talked about, and all the factors contributing to the viewership shares and where the viewership stands. Also, important to note is that the last year has been pretty soft on the ad expense. So how do we get our digital revenue? Is a function for viewership and the ad expense largely on the channel like YouTube. So the ad expense has also been reasonably soft in the last year compared to it was some 2 years back. It had grown very heavily, and it is climbing a heavy base. So that also has contributed. So the ad expense has not also been very strong in the last year. Obviously, in our channel, because there are a lot of sports and other events which happened. You had IPL and World Cup and so on and so forth and all that, on which money is moved. So while we are on an upward trend and the trajectory looks okay, but the growths have been soft on account of what Hiren said, and also on the account of the ad expense.
So Hiren bhai, basically, do we understand that somewhere digital media, traditional media has done much better for us in last 3-4 years compared to the digital media?
Particularly last about 4 to 6 quarters, it has done better. Prior to that, digital has been growing equally strongly. And also the reason, let's not forget, is the fact that there has been a significant underlying investment in the broadcasting business initiative itself. So as the channels have grown and matured and all of that, there is a new stream of revenue that has come up, and which has grown robustly and contributed well to the overall picture.
No, so reason why I'm saying so is, sir, now we have sitting on almost 450-460 crores of traditional media business.
Correct.
Right? So that again has built up in last 3-4 years. So this base has become larger. So how do you see this particular segment of the business doing in next 2 years?
So so there are two parts to this. One is, so firstly, if you ask me frankly, beyond a point it doesn't matter, because the content that we are, whether it's for broadcasting what we are creating, or whether it's Bollywood content or Gujarati or anything else, it's ultimately the content which works. Where the consumer comes from, it really doesn't matter. Okay, whether the consumer is coming on television platform or on digital platform, it doesn't matter, because either way we are well placed to monetize it and earn out of it. Secondly, in the way forward, industry estimates on television advertising are somewhere in low single digits, 3 to 5%, in terms of growth. And digital are, as I said earlier, somewhere in the range of about 13 to 15% advertising growth. Within this, given the fact that we have been overall gaining viewership share on the television side, and also we have obviously grown faster and taken away some revenue or added and grown from there. So frankly, as I said in the earlier point, that it doesn't matter. We have to be firstly where the consumer is, and secondly, we have to have a monetization mechanism available. I think that is probably more important. Now, just we met whether people are consuming on television or on or on the digital media, how does it matter? We are there to capture the revenue on either front.
Last thing, sir. In last 3-4 years, or precisely last 5.
Mr. Rahul, I would request you to...
Sure. Okay, I'll come back.
Thank you. The next question is from the line of Rishikesh from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. So can you please tell us the adjusted EBITDA for this quarter, and how much expense was for new initiatives and how much was for inventory write-off?
This quarter, the expenses for the new initiatives was 10 crores, and the adjusted EBITDA for the quarter was 3 crores, and for full year it was 81 crores.
Okay, and what was the investment for new initiatives in FY24?
81 crores.
Okay, and what investments do we see for FY25?
We are estimating that investment to be approximately in the range of about 50 crores.
Okay, and how do we see these investments or new initiatives going ahead? Can we say that FY25, let's say you said 50 crores, and what year can we see that they will go down significantly, let's say below 10, 5, something very minuscule number?
So there are two parts to the investment. One is the television broadcasting investment, and other is the Shemaroo. These are the two key components of the investment. Television broadcasting, we are looking forward that probably somewhere in the next 4 to 5 quarters, we should be significantly nearing a break-even kind of situation. As far as Shemaroo is concerned, OTT industry still, in fact, currently the OTT industry is not doing that well. So we have actually toned down even in this current quarter gone by, and this thing way forward also, we have toned down the investment. We believe that this business is likely to stay in investment mode for at least a couple of years more, till it doesn't achieve a critical mass on consumption, viewership, and adoption kind of numbers. So our effort has always been to be as frugal as possible and manage the overall investments within a certain amount on an annual basis, rather than overspending or overpaying on things.
Okay, got it. Thank you very much.
Thank you. The next question is from the line of Yash Kukreja from Equity Capital. Please go ahead.
Hi. Thank you so much for the opportunity, sir. So we have seen around a 20% growth in business for Q4. And sir, and most of it was driven by B2B transaction, I guess. So sir, I wanted to understand the performance of the 4 channels that we have. So I wanted to understand the revenue relation growth from the first channel, and also the update on the the most recent. So how are we seeing this revenue realization growth? And also, sir, how long does it take for a channel to break even?
Okay. Saurabh, you want to answer this? Or?
Yeah, I think so. I'll answer because this question keeps coming. I think the 4 channels are on different kinds of revenue trajectories because of obviously one is the duration of the channels in existence and the kind of competitive spaces they operate in, and the kind of viewership shares that we have been able to generate out of there. I think if I look at it, and it's difficult, and we will not be able to give numbers to it, but I think from point of view and from a completely stabilization point of view, I think Shemaroo TV, the first channel that we launched, is it's very decently on its way forward, and we see that trajectory continuing the way it is without any too much of challenges and bumps. Then we have Shemaroo Marathi Bana, which also was very earlier channel. Of course, it operates only in Maharashtra and has been doing reasonably well with some ups and downs because we have been investing in fresh content only towards the second half of last year, and it was doing quite okay. But in the as you might know, come April this year, we have brought it out from the Swedish space for various reasons, largely being the license cost being too high for the kind of space that it was in. So obviously Marathi Bana we are starting relatively afresh with now completely it being in the pay world. We are readjusting our content or readjusting our programming, because it's almost a fresh start for Marathi Bana. Though it continues to play in, it was in the Swedish part, part of Maharashtra is only 15%. And it continues to be in the pay world, but obviously the strategy and the content programming, etc., will go through some changes. The 4th channel, which is the very new channel, which is Chumbak, which was launched in the middle of last year, I think it has stabilized and it's really doing well, considering the time that it has spent. And we have reasonably strong hopes on the channel this year. The way it is trending also looks good. So 4 channels are in 4 different spaces. Shemaroo, as I said, Umang, which is our main channel for original shows, went through a bit of a up and down kind of a situation. That channel, we had launched quite a few original shows, which we had brought down in the last quarter because some of the original shows were not doing well. We still continue our focus on the originals there, with right now having a couple of original shows, and we have plans to dial up again in the next couple of months there. So that channel is the one which we have a lot of plans and hopes for in the future. But it's going through a slightly rocky phase because it is largely dependent on original creation. So, and in terms of profitability, again, this question has been asked many times. It's a question of, different channels are in different states. At an overall level, as Dhiren said, somewhere in the 4 or 5 quarters down the line, we hope to have an overall break, but with different channels in different states. Dhiren, you want to add anything? You can add.
No, I think fairly put. Just one point I would like to add is that one of the factors which actually put the free universe a little behind by about happened last year, which was a rebasing of the sample universe done by the ratings agency BARC, and that has in a way shifted out certain numbers, and that has, so one of the impacts for last year definitely has been this rebasing effect, which we are fairly hopeful that that correction back should happen during next few months is what I think, and that will of course definitely change a certain amount of the revenue that has been given up.
Okay, sure. And so my second question is, what is the update on the launch of new channel?
So we are Or you want to?
Yeah, we are, as of now, we are again in the state of evaluation of the launch of channels. I mean, that's something which we'll always be open to because we want to have a network of channels. As of now, we are still evaluating when and how to launch the next channel. Yeah, again, sorry.
Yeah. No, so while we are in a certain state of readiness for that, but yeah, given the last couple of quarters events on the external front, which is the advertising landscape and all of that, we have ourselves gone a bit slow on that and are evaluating the viability and things like that.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Dhwanil Desai from Total Capital. Please go ahead.
Hi, thanks for the opportunity again. I have two questions. So first is, if I look at our GEC viewership share, even if I adjust for the rebasing effect that happened last year, we are at around 7.1 to 7.5, which used to be slightly higher. So my question is that, let's say if we don't launch any new channel, and considering that we are running at full inventory, like you explained in the earlier calls, the only way to grow is through, higher effective rates, so ad rates. So without viewership share increase, the only lever that we have is the improvement in the external environment. Is that a right assessment? And if so, aren't we too dependent on the external factors on that? And how do we see our viewership share growing?
So there are... Yeah, okay.
Yeah. So, Dhwanil, I mean, external factors will always be important, right? Because we are in the free dish space and in the GEC, in the Hindi GEC space. And in free dish space, as you know, the revenue model is completely advertising-led. So there is an externality, but at the end of the day, remember that free dish Hindi GEC caters to a very large audience which is not catered by the pay audience. It's a very large incremental audience. So there is enough and more space for advertising monies to come, and advertising monies will come. And so it is a function where a lot of it is a function of demand and supply. You're right. And as I was just indicating, as it's showing some green shoots of opening up again in this quarter. And hopefully, post-election and everything stabilizing, we also see, we are very hopeful that the coming festive will see some strong rebound in the advertising revenue. So that is demand. That is one. Second is in terms of viewership share. You are right. Our viewership share is slightly suppressed more than compared to what we should have been. And as I said in the previous answer, there are some of our original shows which did not work as well as we wanted. But as you know, or if you don't know, let me just let you know that what happens is in Hindi GEC, normally the strike rate of shows succeeding is normally in the range of 1 or 2 or maybe 3 max out of 10 shows succeed. So it's not that none of our shows succeeded in the beginning. The first show that we had launched, Kismat Ki Lucky Rose, did reasonably well. But subsequently, some of the shows did not do well. We are right now also working with some of the top producers, bringing in newer shows. We are also being very quick in replacing shows which are not working. So we have a cogent and well thought out programming strategy in place to drive viewership share. Irrespective of the fact whether the advertising market opens or not, we have to continuously strive to drive our viewership share through smart programming. So that's where we are. We are also taking quick calls. Hence, in this last quarter, we have actually saved a lot of our investment by shutting shows which are not working. At the same time, we are also commissioning shows with best of producers with the best of cost. So it's going to be a combination of both. It is not just relying on external factors, but which are very true, which external factor is important, but also at the same time driving programming shares with as much smart programming and smart way of handling our content as well.
Okay. See, the question that I have is, and the point that I'm trying to kind of, arrive at some kind of a understanding is that, in the earlier version of Shemaroo, we used to do 27-28% EBITDA margin, and now the way we are charging off inventory, apparently we were charging off inventory on the lower side content cost, and hence probably those margins were also not true reflection. Today we are in the space where we are still in the flux in terms of businesses scaling up. So as a management, when let's say 700 becomes 1,000 crore as we scale up, how do you guys look at EBITDA margin? Because from the moving parts that they are in the business at the current juncture and the accounting side of it, we have absolutely no clue, how the margins will evolve. So unless you guys help us understand how you guys think, at a scale, how this business will have steady state margin, how would we get some sense?
Okay. So there are two parts to this answer actually. So firstly, on the margin on the traditional business or on the erstwhile business model, which was the aggregation, syndication, and content business, that I don't think changes. Even now, if you see the underlying adjusted EBITDA and all of that, those margins are in that range only. That cash flow is also in that range. Because if you see this year, after an investment of 81 crores, the debt has gone up by 18 crores. Okay. So there is a underlying free cash flow that is getting generated, but it is being invested. Now, yes, the fair question is that whether that investment has broken even, what is the visibility on that break even, and then in a steady state, what are the margins on, or what kind of margin business is that? Okay, I have 2 points over there. One is that, as I said earlier, that business, we are looking forward that in the next 4-5 quarters, that business should reach a steady state, at least a break-even kind of a position. Okay. And this business is known to have, supernormal margins. We have enough and more, data from a lot of other peers in this industry who we know are working at significantly higher margins. Now we are saying that may or may not happen, and it may take some time to happen. But at least once the business is on a certain path, the way forward on margins, free cash flow generation, and sustaining the business in its way forward is the important first step that we are looking forward to achieving on that. And I think we have a lot of levers for that, some of which are external, but quite a few are internal also, and we have a fairly capable team in place to actually push and drive a lot of those levers. That team has been brought in place over the last about 3 quarters or so. It's now over the last, as I said, 3 quarters has stabilized at a certain level, and now is raring to go in terms of taking the thing forward. And we are definitely hopeful and confident that they will be able to deliver significantly strongly on that. And the second part to this is that this business, in terms of its working capital nature, is very different from the aggregation business, because this is a relatively smaller working capital business, notwithstanding in fact the fact that we have been steadily investing. But fundamentally the working capital nature, if you can see on the balance sheet effect also, is significantly different. So I think that is, if you ask me, the way to look at it. So it will, even at a slightly lower margin, this business can improve the return ratios for the company quite significantly.
Okay, got it. And just one small request, sir. Like you have been giving new initiative numbers separately. if you can give the inventory charge-off numbers also separately, because otherwise, again, we will have no clue how much of inventory is getting charged every quarter. What is the normal consumption and what is the extraordinary charge-off?
Sure. We will look into it. I am not able to confirm that right now, but yeah, we'll try and address it in some way. The idea is not to not give, but some. So what happens is that as we go forward, there's a challenge on the numbers because fresh inventory, etc., comes and it all becomes finally, fungible in that sense, as in it kind of becomes one block. So to calculate the base and all of that is a challenge. We'll still try and attempt to give as accurate. We'll look into it.
Okay. Thank you. That's it.
Thank you. The next question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Hello. Thanks for the follow-up. So, Hiren, just to understand this year, if I look at our operating profits, apart from adjusting for the 81 crores new initiatives, there is a 12 crore GST provision and there is a 10 crore incremental or excess inventory write-off. Is that clear? Is that right?
Correct.
So if I look at last 3 years of operating profit adjusted for the new initiatives, those profits have been around 100 crores only, no change. They have not moved up. Our margins also, the operating margins again for adjusted for this new initiatives as well as this current year's inventory and GST, they have actually fallen from around 27% to 14-15% now. And as the previous participant was talking about earlier, we used to get around 27-30% or 25 to 30% range of margins. In last 3 years, those margins have now come down to 14.5-15%. So one, what has actually led to this deterioration of margins and what is the steady state margins for our business now?
I don't agree with that. It's a very, I would say, arithmetical way of looking at it. So you adjusted the numerator but not the denominator. That's my only concern on that. So this is a separate discussion. You can probably look at separately, but that margin, what you are taking off, you have to even take off the top line from the denominator. Then you will find that the margin on that existing business is maintained.
Top line from the denominator?
Yeah.
Okay, I'll possibly take it offline.
Yeah, that's good.
So now in last 5 years, we have spent 300 crores on new initiatives. And is it possible to understand out of this, how much will be spent in cash or how much it will have impacted the cash flow?
So if you see the debt impact, it has gone up by, I don't have the figures offhand, but my sense is that debt would have gone up by about 75 to 80 crores. Rest is all through internal accrual.
Okay. But this 300 crores is mota spent in cash or the cash flow would have accounted somewhere for this, right?
So it is visible in the debt number. No? See, finally, what I am reporting and how the debt is going, you can calculate or adjust based on that.
Okay. And so next 2 years, Hiren bhai, or 2 to 3 years, how do we look at this number of new initiatives? Because what happens is here now we have an excess inventory write-off being done every quarter. So are we trying to say that somewhere we are...
As I said earlier, that this quarter we are expecting, this year, FY25, we have budgeting for approximately 50 crores on the fresh investment side. Next year's visibility, right now I am not able to give because it depends on, we are at the beginning of the year, so I don't know. But yeah, if things go as per how we have anticipated that if we are able to break even in a 4-5 quarters period on the overall business, then the investment in next year will come off reasonably to say only broadly at for Shemaroo and some small amount for the broadcast business. So if we are able to achieve that break-even, near break-even at least situation, or then the next 2 years the investment will come off reasonably.
Sure. Thanks very much, and all the best.
Thank you.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments.
Thank you all for participating in this earnings call. I hope we have been able to answer your questions satisfactorily. If you have any further questions or would like to know more about the company, please reach out to Valorem Advisors, our IR managers. Thank you, and looking forward to seeing you all with the Q1.
Thank you, everyone.
On behalf of Shemaroo Entertainment Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.